Hello. Welcome to CashFlow Hacks. I'm your host, Chris, and with me today is my co-host, Stephanie.
Hey everyone, I'm so happy to be here and I am ready to make more, save more, and start living more now. How about everyone else?
Well, if that's the case, you're in the right place. Every week, Stephanie and I are going to be discussing tips, strategies, or, just keep you in the loop with different topics that your financial advisor doesn't want you to know. And why are we doing this? Because the less you know, the more they make. And we want to help you flip that script.
Right. So this week we're going to continue talking about taxes and money-saving tax strategies. Because, well, it's tax time.
Yes, it is. We focused a bit on taxes due to the time of year, but we have a few more strategies to discuss. So I think it's perfect. With the combination of tax deductions, tax credits, and contribution strategies, you're definitely going to be able to reduce your tax bill by reducing your taxable income.
Absolutely right. And last week we talked about converting SEP simples and traditional IRAs to Roths. We talked about utilizing HSAs. We talked about restructuring business entities and tax filing designations. We talked about investing in tax-exempt bonds. And we also touched on what to do with inherited real estate. This week, we have a few more strategies to discuss. Chris, go ahead and tell us what's on the agenda for today. What are they?
Well, today we're going to be discussing strategies that we hear a lot about in our industry. Whether we agree with them or not, we'll just tell you about them. The first one is maxing out your retirement contributions, setting up a donor-advised fund, and we'll also touch on tax residency planning and investing in an opportunity zone. And you love to talk about the 529, so we're going to do that, even though we have different opinions on that.
Exactly, right. Well, great list of strategies to discuss today, and it should generate a good conversation because, you and I will look at them from different perspectives. So let's start with maxing out your retirement contributions.
All right. Well, this one is interesting because I kind of have mixed feelings about it. Qualified plans, when I'm talking about qualified plans, I'm talking about like our employer-based accounts like 401ks, 403bs. These they're supposed to help you lower your taxable income. And the reason for that is because every dollar that you put into these accounts is not taxed now. It's not taxed until you start withdrawing the money from your account. So today it will reduce your tax burden and every year that you do it. But I personally believe that this strategy really depends on the person. If you make a lot of money, it's one great way to lower your tax burden. It's actually the reason 401k was created. But we've been told all our life that we're going to, if we wait to withdraw our money from our retirement in our later years, then we're going to be in a lower tax bracket. But the question really is, do you think that's true? Do you think you're going to be in a lower tax bracket? Well, on one side, you could have fewer deductions than you once did. And that means that when you withdraw the money, you're going to be paying higher taxes. Not only are taxes going to be higher in the future, but also if you're making more money in retirement than you did now, then you're going to be not going to be in a lower tax bracket. What do you think? Do you think you're going to be in a lower tax bracket? Do you think that taxes are going to be going up or down? And just realize that this strategy can be good for certain people. And when I suggest doing it, I usually suggest using a self-managed or self-directed IRA.
Yeah, absolutely. And that's a really great point that you talk about. Like, we can reduce taxes this year by putting away money for our future. But that is a question that always pops up when I'm talking with clients, when you're talking with clients, is that, hey, are we really going to be in a lower tax bracket? And what is that based off of? I mean, working with you, CQ clients, CQ consulting clients, they grow their wealth exponentially. I love that word. But they're going to have that, substantial wealth growth. And they're also going to have cash flow, which means that their passive income from the investment in real estate, for example, that'll continue to come in. And so if they have that income coming in, and they have RMDs that kick in at age 72, necessitating them pulling out a percentage of the balance, which right now at 72 is 3.66%, that could keep them in the same tax bracket or even, higher. Let me give you an example. Let's say that you grew your 401k balance to $5 million, right? At 72, you'd have to pull out that 3.66%. That's $182,500. That plus any passive income coming in, well, that could keep you in the same tax bracket or even a higher tax bracket. And, because I love to data dump, just so everyone knows who's listening, who might have thought previously that, hey, I'm going to be in a lower tax bracket. I just want you guys to know that RMDs can push you into a different tax bracket than you thought. At 72, like I mentioned, it's 3.66. But the older you get, the more that the government mandates that you pull out of these types of accounts. So at 75, it bumps up to 4.07. At 80, 4.95. And at 85, 6.25. So the government who says you can, pay taxes later, well, when later comes around, they're like, you're going to pay taxes now. They want to make sure that they get their taxes later. So they start mandating that you pull a percentage out. So really take that into consideration, when you are thinking about what tax bracket you're going to be in the future. But I digress. So you can take advantage of tax reducing benefits in retirement accounts by contributing the maximum amount. For 2023, 401ks, 403bs, and SEPs, contribution max is $22,500. And if you have a simple IRA, the max is $15,500. So just keep in mind, if you're over the age of 50, there are some catch-up contributions. So there is a large amount of money that you can put into these accounts to help lower your tax liability for the year. And, it helps you secure your retirement if you start planning early. So what are your thoughts, Chris, about that?
Well, I think you know how I feel about it, but let me just tell the audience here. I think when we have qualified plans, that we're basically in partnership with the government, and they're the ones that tell us when we can take out our money. They tell us when we have to take our money. And this is exactly why I say, it's not exactly the best strategy for everybody. And that's why, as G2 Consulting, we have a team that works with our clients to look at their personal situation from all different angles. When we design a plan, we look at the legal side, the tax ramifications, as well as looking to find, the best opportunities for our clients. And sometimes the advice that we hear is a great tax strategy. It might not be a great investment, or a great investment might not have the best tax, the tax implications, actually offset the gain.
Yeah, that's a really good point, Chris. Really clever to think about, like, okay, I can't just look at it from one angle. I got to look at it from many.
Right. And, the other, another strategy that I've been talking about lately is moving to Florida, moving to another state where the taxes are less as far as income tax, no state income tax. And I would love it if you could share with our listeners about tax residency planning.
Oh, sure. Yeah. Okay. So one tax planning strategy to consider is if you own properties in multiple states, is you can, consider tax residency planning, or like you said, Chris, in your case, just perhaps moving there. But I want just to, kind of do an overview. You know how I am, just a careful person. It does require careful planning, this strategy, because you have to pay attention to detail, and you want to do this with an experienced tax accountant. Okay, so yes, income tax rates vary from state to state. Some states have really high tax rates, and then some states, like you mentioned, Florida has no state income tax. Right? Florida's actually not the only state that doesn't. There's Alaska, Nevada, New Hampshire, Tennessee, Texas, South Dakota, Wyoming, Washington. So if you have property in one of those states, you can think about establishing your primary residence there. But like I said, you have to be cautious because these states aggressively pursue high earners if they think that that's what you're trying to do. So as they earn money in the state or try to work around paying income taxes, they might come down hard on you, which is why you need to work with a tax accountant. And just so that you know, just because a state has low or no income tax, they may charge higher tax rates for other things, right? So you want to like think about it and balance that out. My ultimate thing about this specific strategy is definitely work with a professional accountant to determine your individual situation and the state that you want to move to. Because, that way that you can really see all of the nuances and know if this is the right strategy for you, like it is for you, Chris. But for the listeners, I want them to, make sure that it's the right strategy for them too.
Right. And plus, not everyone can just get up and move. So there is another way. If you have capital gains and you want to reduce your tax burden for those gains, there is a way, and that is investing in an opportunity zone. This can help defer tax payments. And these opportunity zones were created as part of the Tax Cuts and Job Act in 2017. So according to the IRS, the purpose of these opportunity zones is to basically is to spur economic growth and job creation in these low-income communities while being able to provide tax benefits to investors. So they create a great incentive. If you invest your capital in these areas, you can defer your capital gains taxes.
Yeah, so that's really interesting. So if you can't move, you might be able to just invest in those opportunity zones as a way to lower your tax liability. I love that.
Right.
So we have 2 more strategies to discuss, non-real estate residency related. The next one is more charitable. The first one I want to talk about is donor advised funds. So tell us a little bit more about donor advised funds, Chris.
All right. Well, you already know that donating money to a charity offers us the opportunity to have a tax deduction in the years that we make that donation. But what you might not know is that you can actually get a deduction this year for several years' worth of contributions if you set up a donor advised fund. A donor advised fund is a charitable fund that you can personally set up, and it allows you to decide how and when to allocate your funds to individual charities. You can make contributions this year up to 30% of your income and take the full tax deductions this year on your tax return. So what will that do? It will reduce your tax bill, and then going forward, you can decide how much money to donate per year and where you want to donate it. And in short, basically, you're receiving the tax deduction when you fund the donor advised fund, not when the donation is distributed. I love that.
Cool. That's very, very cool. DAFs are great for high-income clients, especially if they have a year where they have maybe higher than normal income. And that could be due to maybe a bonus, maybe inheritance, windfall, whatever bumped that up. A great sales year, I don't know. But it's a clever way to use charitable deductions to your advantage. And one thing that I love about DAFs, because I'm a little bit vain, but you can name them. So like I could have the Georgia Copolis Fund if I wanted to, or I could, set it up in someone I care about name. Maybe, if I do the Achilles Fund for Pomeranians that get sick with cancer. But you can set them up with your own names. I don't know about that last one about Achilles, but you can set them up in your own names. And so I think that's super cool. You can leave a legacy like that.
Well, that's right. But not only, why don't you tell them about not only, let's talk about them 529 plans.
Yeah, so not only can you do it through DAF, the last strategy we're going to talk about today, which is the 529 plan. So I personally like 529s, and it's most probably because this girl has $157,000 in student loan debt. So I think about this a lot, right? So paying for college, it's a significant expense, and that's true whether you are a middle class, upper middle class, high earner. It's expensive no matter what. So one way that we can reduce taxable income is by funding the 529. Now, I have a lot of opinions and things to talk about when it comes to 529s in general, but today, since we're talking about taxes, I'm just going to stick strictly to the taxes. So the 529 is a tax advantage savings account, right? The earnings generated in a 529 are not subject to your federal taxes. So this lets the investment grow without being depleted annually by taxes, right? So that's a benefit. Also, when the money is used for qualified educational expenses, the distributions are not subject to federal, state income taxes. Also awesome when we're looking at just taxes. So as we're doing this overview on taxes, using a 529 plan to fund college education costs provides a variety of state and federal benefits. Most states offer some form of state income tax deduction or credit for the contributions made to the 529 plan. Some states don't. While these state benefits vary from state to state, usually they're enhanced if you are doing an in-state 529 plan. Meaning, if I live in Ohio, I can invest in the Illinois 529 plan. But if I invest in the Ohio 529 plan, the state is going to give me a better tax benefit. So there are a couple of states, though, like Arizona, Kansas, Maine, Missouri, Montana, and Pennsylvania, and they're called tax parity states. So they kind of offer income tax benefits regardless of whether or not you get their state's 529 or another state's 529. So the reason I'm bringing this up is because you kind of want to see, like, maybe Illinois, in my example, 529 is performing better than the Ohio 529, and you're like, hey, I want to get the Illinois, it's doing better. You want to kind of offset what would my tax savings be? Because if the tax savings makes it actually so that your overall, how we were talking a little bit earlier, Chris, about how, we look at it from all angles. So maybe the tax benefit is not outweighed by the better investment somewhere else. So I digress, but that's kind of what I was talking about when you want to look at things from many different angles. But let me give you an example. So let's say that you're in Pennsylvania and you can deduct up to $14,000 of contributions to a Pennsylvania 529 plan for the year for each beneficiary, right? So let's say you have 2 kids, it could be $28,000. But with a state income tax rate of 3.07%, which is what it is in Pennsylvania, you're going to save about $430 per year in taxes. And it would be $860 if you had 2 kids, right? So it can result in a decent amount of income tax savings. And that's just with Pennsylvania's 3.07, right? So some states have even higher state income tax rates, so your savings are going to be even greater. Now, I know this is a lot of tax conversation, but that's just the topic of today. So I do want to talk about non-qualified withdrawals and how they're taxed. So it's taxed on a pro rata basis, which means a portion of your withdrawal is going to be treated as a return of your contribution, right? Because that's the money that you put in. And then a portion of your withdrawal will be treated as earnings. So again, I'm going to use that $14,000 as my example. So let's say the 529 plan, you contributed that money. 5 years later, the account has grown to, let's say, 20 grand. So if you want to figure out what portion of the account is taxable, you would have to take, 70% is the contribution and 30% is the growth in this example. So if you take out a withdrawal of 10 grand, 70% of that, 7,000, is going to be a return of your contribution, and 30% of that, 3,000, will be earnings. So you would pay federal income taxes on the $3,000 plus a 10% penalty, right, on top of that for, pulling out for a non-qualified reason. So let's say your federal income tax rate was 28%, you would owe the 28 plus a 10% penalty on that $3,000. So could also owe, state income tax on the $3,000, and maybe, depending on the state, you might owe some state income tax on the $7,000 contributions, but it would just depend. So it's not that you pay that 38% on the whole amount you take out. It is a pro rata basis. Some people are confused about that when, they say, oh, I pay taxes and I get the 10% penalty, but it's not on the whole amount you pull out. It is on a pro rata basis. So that's something else to consider. There are some more complicated tax issues that can arise with 529 plans. I told you guys, today I'm just talking taxes. It's a little bit dry. I apologize, but it is our tax conversation. So questions.
I'm glad you're telling them about, even though there's some good things about the 529, you're at least letting them know the negative parts of the 529. Those are the reasons why I don't like the 529. So keep going, keep telling them.
Right. So where was I? Oh yeah. So there are some complicated tax issues. So what are the complicated tax issues? Well, Contributions to a 529 plan count as taxable gift to the beneficiary of the account. But you can offset this tax issue by applying the annual federal gift tax exclusion amount to the gift. So you see how it kind of gets a little convoluted, and it might be a good idea to talk to your accountant. But what this is it allows someone to be able to gift up to the $14,000, which is why I kept using that as my example, without incurring the federal gift tax. If you're married and you file jointly, you can do gift splitting, and you can fund the account with $28,000 per beneficiary. And if you really, really want to contribute even more than that to a 529 plan in a single year, there is a special rule that allows an individual or couple to gift up to 5 times the annual federal gift exclusion amount in 1 year, and then spread the gift evenly over 5 years for gift tax purposes. So the reason I bring this up again is because I'm talking taxes today. If you did want to lower your taxable amount, this might be something that you could look into, this section here. And then finally, contributing to 529 can be extremely useful for state tax liability, because you can contribute, like I mentioned, up to 5 times the annual exclusion for gift at one time. And so that removes a little bit of those obligations from your estate. So those are the things that I like to talk about when I'm talking about taxes around that 529.
Wow, that was a lot, Stephanie. So if you're listening to this and you have about the 529, this is our pro right here, Stephanie. She can answer any of your questions about that. But let me just say, I personally do not like 529 plans. I think life insurance can do the same thing, and I just want to share a couple reasons why I think that the life insurance can be a great way to do this for our children. The first one is that you don't have to actually count the cash value when say our kids want to get a loan, they want to get a student loan, they want to get federal student aid, and if they have this 529 that has a lot of money, it actually counts against them, and you end up paying more for your children's schooling than if you did not have that. So your payment, the tuition, out-of-pocket tuition payment, is going to be a lot higher if you have one of these 529 plans. And so when I think about it, I like to think of saving for college versus saving on college expenses. If you don't have your assets allocated properly, then you may have to utilize all the money that you saved in the 529 to pay for your child's college. I know that's what it's there for, but what if your child doesn't want to go to college? If you have them allocated properly, then you might be able to get reductions, grants, and the cost of your child's school could be $20,000 less per year. And over 4 years, if you think about that, that's $80,000. So you didn't have to pay that. You put yourself and your family in the position to save on college expenses to the tune of 80 grand. So I think that's more important. And I always talk about cash flow optimization. Let's spend our money wisely. And since we're talking about tax strategies here, I have to put my thoughts in it, as you did, Steph, about the pros and cons each strategy has overall. And I like to talk about that regardless of the potential tax savings with the 529, it doesn't really outweigh the benefit of having the flexibility in what you can spend your money on. Sure, you need to go to college to be a doctor and a lawyer or an engineer, but what if you don't want to do that? What if you want to just do a trade, or you want to start your own business? You have to spend the 529 on schooling. You can't use it to start your own business. And when you have a whole life policy, you can start your child's business, or if they want to be an electrician, or they want to be whatever they want to do, whatever they're passionate about, they can use that money to help them start their own business. And really, it's going to be able to put your child and you in a better position. What if the other thing you could use that money on is, what if your child wanted to use that money to buy their first home, or buy a rental property? You want them to get into real estate so they can start having their cash flow they can get started with their investment career instead. And I like that. I like to be able to do whatever it is that you want to do. But anyways, that's all I have to say about the 529 and life insurance. If you have any questions about that, I'm here for you. But let me just say, the strategies that we have outlined today on today's podcast, they are supposed to help you reduce your tax bill. And a lot of, like you said, a lot of other things, or like we've said, a lot of other things come into play. Not just reducing taxes, but is whatever strategy we talked about, is it best for your overall growth? And the best way for you to identify tax incentives and strategies is to work with somebody that knows, a financial professional that understands what the tax implications are going to be. And so, if you need help determining what the best tax reduction strategies are, you might want to give us a call. We might want to talk. And you can schedule a call with us on our website, eqconsultingservices.com.
Yes, thanks for that, Chris. I learned a lot. Like you said, there are definitely other strategies that might be better when you're looking at things from multiple angles. When you're looking at just tax strategy, it might not be the best investment. When you're looking at investment, it might not be the best tax strategy. So there are lots of things that you have to look at. So it's always good for people to, reach out. And like you said, they can schedule a call from the website. So we had a wonderful discussion. We've looked at things from different angles, but I would like to know, did we generate any questions from our listeners? Did we answer everything that, has popped up in your head? I know you've heard some of these things talked about, and we're here to try to answer all of those questions and help you think about things in a different perspective, in a different light, so that it is in your best interest. So with that being said, we want to hear from you. What do you wish you knew more about? What do you want us to talk about in more depth? When you leave us a review, a 5-star review on Apple Podcasts, go ahead and ask in the review anything that you want us to talk about, or you can send our Facebook page a message.
Check us out on Facebook. Give us a 5-star review. I love that. That is going to wrap us up for this week. Thank you for tuning in. Join our Facebook group. It's called CashFlow Hacks. And follow our page, CQ Consulting Services, and our YouTube channel, our Instagram, LinkedIn, Twitter. Subscribe and give us a like, thumbs up. Remember, sharing is caring. Yeah, you know that needs this information. Thank you so much for listening, and we will be back next week with tax-free retirement. See you next week to continue helping you flip that script.